Travillian Next is a division of Travillian, a financial services specialist search and talent advisory firm. Since inception, the Travillian team has dedicated itself to enhancing the return on investment of a company's most important resource, its people.
Hey everybody, welcome to the Travillian Next podcast. My name is Michael Perito and I recently joined Travillian as head of bank strategy. I'm excited to be here today with David Feaster, highly accomplished equity research analyst from Raymond James, specializing in the banking sector. David's been at Raymond James for 16 years. He's also coming off one of the more grueling weeks of the year for a sell-side analyst, bank earnings, so we appreciate him being here. David, welcome.
Thank you. Thank you very much. Excited to be here.
Yeah, before we chat about earnings, I did want to ask you, the mindset of bank investors leaning into the second quarter. I imagine there was maybe some slight optimism starting to brew around rates, maybe better comps politically on the horizon, but I would love to hear the conversations you were having pre-quarter about bank earnings with investors.
Yeah, absolutely. And again, thank you for having me. It's a privilege to be here talking with you all, so thank you, Mike. But yeah, the prospects of more Fed cuts has definitely improved sentiment. And if I was to take back, it's almost as if there's been two rallies, right? I mean, it really first started with the debate, the presidential debate, and the prospects of a Trump victory and how that might benefit the M&A market and the prospects for bank stocks. But then that rotated to down rates and the potential for Fed cuts. And that improved sentiment around the space. And I think investability of the sector, especially from the credit perspective, that's been the biggest hang up for a lot of investors, is just having no appetite for credit risk, which is why so many have been underweight the space. There's still a lot of questions, though, about whether a credit cycle is still coming and whether rate cuts are actually going to even solve that. We're still not out of the woods yet, but sentiment has definitely improved. And while the initial rallies seem to be more index-driven or maybe some short covering, I'd tell you, as we move through earnings over the last week or two, we've seen a lot more generalist long-only interest in the space. It feels like this might be a more structural shift in sector allocations, and we're starting to get back closer to equal weight versus the material underweights that many investors have had. But again, additionally, the prospects of down rates also giving comfort, starting to move down cap, which is important. And the rally in stock prices and the improved valuations is making the viability of M&A increasingly likely. And so that's driven some of the rotation from the mega caps to a bit more downstream. And I'd tell you that it feels like that leaves more tailwind for the smaller cap banks. Definitely encouraging to have more of those long-only conversations. It's driving more questions on individual names. And that's probably going to increase disparity in terms of stock performance, based on individual company performance rather than that kind of rising tide lifting all ships,
Yeah, and obviously off of low levels, but it's definitely encouraging to see sentiment turning around a little bit here. We'll see if that has legs as we move into the back half of the year. Maybe that's a good segue. Obviously, David, you do a ton of prep for earnings. You have your previews, all your calls with investors, management teams. You have your non-deal roadshows intra-quarter. With all that prep, what were one of the two biggest surprises for you this quarter as you work through all those bank earnings?
Yeah, it's an interesting question. Honestly, though, I'd tell you, heading into quarter end, it felt like things were relatively in line with expectations and kind of, for the first time in a while, in line with expectations rather than some big reset. And it was kind of uneventful heading into earnings. To me, I would tell you the key descriptor it felt like would be stabilization. And that comes on a lot of fronts, from margin to funding costs to loan growth. But there was a lot of conversations around the competitive dynamics and a tepid demand in the market. And a lot of that still persists today, but there's just a lot more confidence that we're in the midst of a troughing process and that visibility into that potential inflection is starting to improve. Again, we're not out of the woods yet, but there's definitely increased optimism about the future. And, one of the major questions that I tell you that generalist long onlys have been asking management teams when we do these roadshows and investor meetings is, when can we get back to normalized levels of profitability? It seemed to be more of a 2026 story, just given the repricing dynamics and funding cost headwinds. But management teams, they've all admitted, look, the key to this is going to be core deposit growth and funding costs. Down rates could obviously accelerate this for a lot of banks, But exclusive of that, it's just going to take time. That's really going to be the delta. And with that, it's really about the trajectory heading into 2025, and I tell you even more so exiting 2025, that's allowed us to start shifting from more of a tangible book support type valuation more towards a PE focus, which is obviously more of a growth type metric, and we'll be shifting more towards 2026 earnings in the next few months.
Right.
So again, it's on the price of tangible book side, that's the other encouraging thing is that with the 10-year down to 415 or so, we're going to get some relief on the AOCI side. So that definitely helps as well.
Yeah, I think it's interesting to think about some of the asset dynamics too, though, right? Like I think there's rightfully so a ton of focus on core deposits, but it feels like banks have finally caught up a little on asset pricing as well. I think initially in the rate cycle there was a lot of underpricing of fixed rate assets, just to generate loans, keep relationships. It took banks a long time to get to the high 7s, 8s, and really, I mean, that's where you need to be to have a 3% NIM, and it gets tough when you get down into the 2s. So, that all makes a ton of sense. As you work through the week, and I know you probably, if I could guesstimate, 20 to 25 bank earnings in 7 days.
Yeah.
Were the big reactions from the market, were they similar to prior quarters, like worst NIM guide, CRE charge-offs, like anything else? Were those some of the bigger factors driving bad negative performance or positive performance if better, and was there anything else you think that was worth mentioning?
Yeah, no, just kind of given what we were just talking about with rates down, it seems like investors are looking past credit concerns, because that definitely happened in the quarter, more of a normalization. But my sense is the best performers are those that have improving growth prospects. Again, the most leverage to down rates, especially from a profitability perspective. Rates down clearly has been the biggest driver of stocks. And again, the market seemingly look past that normalization in credit trends with that down rate mindset. But it almost benefits the benefits of rates down. I tell you, it's almost like there's two different sides. One being less concern on credit, and maybe a bit more increase in risk on or playing less defense. And then the other side, who can drive the most PP&R growth going forward. And with this outlook, it does feel like we've seen an increased focus on growth. That's come back, which is honestly great. Just getting back to maybe early cycle and focusing on growth prospects rather than just playing defense, that's a lot more fun. The only other thing that I'd note is that deposit performance is still key. We all know that the franchise value of a bank is its core deposit base. And to the extent that we have confidence that core deposit balances and funding costs are stabilizing, those banks have also done very well. There's still a huge amount of earning asset remixing and repricing that's going to benefit the margin. And to your point, I mean, it's the asset side. It's just going to take time to get through. But we're setting the stage for pretty material operating leverage in the next 12 to 18 months.
I think the one area that could maybe hamper that optimistic outlook is credit, right? And the commercial real estate market seems to be the area where there's the most credit concern. There's a big rate shock for commercial real estate markets. There's been a lot of concerns around urban valuations on office buildings, things of that nature. Where would you say the sentiment from investors is on CRE credit today? Has it stabilized? Has it gotten any better? I imagine there is some correlation with rate expectations, right? Like if you think rates are coming down a lot, you probably feel a little better as an investor. But what are you seeing on the CRE side from a credit perspective?
Yeah, CRE has become such a dirty word right now. And honestly, one of the biggest takeaways, I think, in the quarter is management teams' focus on reducing CRE concentration. And I think a lot of the commentary, when you listen to calls, it is not for the investment community. It is much more focused on appeasing the regulators and letting them know that they're working to reduce it, because regulatory pressures have definitely increased. That 100% construction concentration, 300% CRE concentration guidelines, those are much more lines in the sand for regulators and I think management teams alike. There's definitely migration happening. Obviously, headwinds in certain sectors, but we lump all CRE into one bucket. there's so much variations within geographies, in asset classes, and even within segments, there's still a lot of discrepancy. A 40-story office tower in a major metro market versus a suburban owner-occupied office, it's very different performance, and we don't delineate. When you hear office, you think risk. And a lot of investors honestly aren't doing the work at this point to delineate between those. But honestly, one of the most surprising things I tell you is how well CRE credit's held up so far. Very, on a broad perspective, reserve allocations definitely increasing. Credit migration is starting to happen, but management teams are still adamant that losses are going to be very manageable, and that this is more of a normalization rather than a significant cycle. But the last thing I'd note is that there's still a pretty active secondary market, and there's a lot of potential capital for loan pool purchases. Some banks are looking to sell pools or exit business lines, and they're having a lot of success doing so. We're having a lot of success across our whole loan trading desk, not just in CRE, but across a lot of different asset classes. And then the only other thing too is with rates down, the shape of the curve matters. Right? I mean, if the 5-year doesn't come down and it's just the short end that comes down, I wonder how much that's going to relieve some of the CRE pressures that we're all concerned about.
Yeah, it's an interesting line because banks want to originate assets to grow net interest income dollars, and to do that though they have to figure out how to lower their duration on the asset side as well, though. So it's this kind of this big complex equation. It's interesting. You're starting to see some JVs pop up to take CRE loans off of bank balance sheets. You've seen some risk-weighted asset swaps, these creative things trying to come into play. Banks leaning heavier into C&I, which historically, honestly, isn't always the greatest thing if that's not really your core competency. But you're starting to see all this types of stuff. And then the West Banco Premier deal I thought was intriguing just because it had that $200 million equity raise alongside it, which really kind of makes you have to think, like, are the banks as well capitalized as we all like to think, right? Or are the regulators, to your point, focused on more below the line metrics such as CRE concentrations versus just looking at your common equity tier one? It's a certain number. It's like, oh, that's great. Maybe not. So it's definitely a fascinating kind of concept within the banking industry right now, but I appreciate that color. I think I'd love to hear a couple more questions for you before we let you run here. Where's Raymond James on bank outlook moving forward? Obviously, there's been a nice lift in the stocks, still far from any kind of peak valuations or anything like that. And I think as you look to 26 earnings, I imagine there's some value still out there. But as you think about the back half of the year, you got the potential Trump kind of catalyst looming in the background. Are you guys leaning more positive, neutral? Where are you guys at as a shop today?
Yeah, I mean, we're still constructive, right? I mean, when you start looking at normalized valuations, the sector's still incredibly cheap, and we're still way under earning on our earning asset base. I mean, banks are structurally well positioned in a higher for longer environment, just given the funding cost advantage. But in terms of how the stocks are going to perform, it's somewhat of a tricky question, right? Because you tell me what rates are going to do, and I'll tell you how the stocks are going to do. There's been an extremely high correlation between rate cut expectations and stock performance of late. And it does feel like we've brought some of that potential Trump bump forward, if you will. But honestly, I just think getting past the election is going to improve sentiment in the market, no matter who wins. Just as business owners, they're going to be able to understand what backdrop they're going to be operating in. They can make more informed investment decisions and capital allocation decisions. And like, as you know, I mean, uncertainty is one of the worst things that you can have for bank stocks, right? Just getting visibility into the election and the rate environment is going to help.
Yeah. I think back to even the beginning of COVID, right? The paralyzing periods of time in the bank industry from a market perspective have been so frequent, just uncertainty. Things are terrible, but then they're great, and then they're terrible, and then they're great. And banks really should not be high beta names, generally. Yeah. And I feel like the beta has definitely been a bit more volatile, the last several years than what's historically normal. Lightning round on the way out the door, David, here. Would love your comments around M&A, or thoughts around M&A rather.
Yep.
We saw a deal. We've seen a couple deals. We've seen some deals close, special circumstances maybe. But is there optimism internally that the pipeline could be building on the M&A side? And then I'd love to hear just what your top idea is, if you're willing, as we look at the back half of the year. I understand the rate uncertainty, but any particular stocks that you really like?
Yeah. It's interesting how fast this conversation can shift. Right. I mean, I tell you, if you talk internally, pipelines are really strong. But in the conversations that I was had into quarter end and the calls that I was having with management teams, they were talking about just how difficult the deal math is. Seller expectations are still too high. Valuations were low. But then when you listen to earnings call after this rally, there's a lot more constructive conversations seemingly happening, and we're likely setting up for increased activity. And, I do think that the election is going to play into that, right? Just from a conversation perspective, because regulatory approval and the timing perspective, the approval process has just become increasingly difficult. Time to close is getting extended. And, a lot of folks are believing that a Trump victory is going to alleviate some of the regulatory headwinds. So with deal math being difficult and dilution still pretty steep, banks are able to get deals done, including capital raises, like you were alluding to. And demand for those capital raises has been really strong. And we just did one a couple days ago, and it was oversubscribed. So that is very encouraging. Don't be surprised to see more of those types of transactions announced. But one thing that's also kind of interesting is we're seeing more M&A out of market, which is interesting. You get obviously less cost savings, but potential easier approval from a CFPB perspective and some of the regulatory perspective. You get less branch closures, no HHI or market concentration issues.
Or CRA friendly.
Yeah, exactly. So seeing management teams, I think it's all over the place. But I've talked to some that are focused on trying to stay smaller and getting more tuck-in acquisitions done because those are easier to get done. But definitely conversations are increasing, a lot more optimism around M&A. So it's very encouraging, and that'll get that sector rotation happening like we talked about.
Historically, M&A has definitely been a catalyst for that. And, for the opposing side, I mean, I was having coffee with a bank executive this morning that said just in the last month alone, they've looked at 5 deals, which was, twice what they've looked at in the 12 to 18 months preceding that. So it definitely seems like there's a bit more conversations going on. For my part, I still have to imagine the bar to announcing and getting to the finish line on something is still probably higher than what it was, just because getting in this regulatory no man's land is tough. It's tough to manage your bank. It's tough to grow. Like I just think of like the Provident Lakeland transaction in New Jersey. It's difficult. It's challenging. And that was a pretty plain vanilla transaction. I mean, it really wasn't anything too crazy or unique. So definitely some challenges, but the conversation increases definitely seem to also be happening. So I guess lastly, David, give me some ideas. What are we looking at? What's interesting to you?
Yeah, I mean, look, I think the sector's pretty interesting, especially heading into this in that rotation down cap. Two that I like a lot right now. I like Glacier. It's an easy to understand story. Gives you some of that downside protection in unique and differentiated markets. And there is a ton of earnings power that's locked up in the securities book that's going to be they can almost double their earnings without having to grow the balance sheet at all, just from that remixing over the next couple of years. And so when you get 10 to 20% compounding EPS growth without having to take on incremental risk, I like that setup a lot. And then again, they're liability sensitive, so downside that kind of gets accelerated down rates. The other one I tell you is Columbia. This one's been tricky because they've had that the big Umpqua transaction, and that one's been there. Those larger type deals can just takes time to work through. MOEs are not easy, but I feel like we are at an inflection point, and I think management has done a really good job executing on some of their initiatives, and I think the trajectory is good. Valuation's extremely attractive. You get a nice yield, and I think the setup there is pretty good in the back half of the year.
Awesome. I love it. Well, if anyone takes action here, just remember David's contributions to your profits. David, thanks for joining us. I know it's a crazy week last week and probably weekend as well, and I know you're probably ready for some August summer, but I appreciate you hopping on and talking about bank earnings. It should be an interesting back half of the year, so thanks for coming on.
Absolutely. Thanks for having me.